briefly, I'm Steve Odenkirk. I'm a principal at Paradise Commercial Finance. I run a commercial mortgage brokerage and workout consulting firm here in Tucson. I've been a commercial banker and a commercial mortgage broker for 25 years. With that, we're going to talk a little bit about, these are slides that Joe put together, and I'm going to do the best I can to interpret them for you. What I want you to take a look at here is the 320. This is 2006, and this is today. This is the net interest margin spreads of all the banks across the nation. And what I want you to understand about this is what our banks are basically earning on their loans, at least by their own internal metrics in some standardized format that's put together by the Fed. What you need to see is, if you see that 3.27 down there, what you've got is you've got a ton of deposits, a ton of liquidity trying to get out and create return. And you've got internal bank credit committees, policies, and the Fed telling banks you can only lend money like this, you can only lend money like this, you can only lend money like this. And the rules are so tight that when there's a deal that fits in the box, everybody wants it. But there's very little flexibility to move the terms of the loan around. You can't go to a 30-year AM, you can't go interest only, you can't do this, you can't do that. So what it boils down to is you got three banks bidding on one deal, and the only thing that they can differentiate on, for the most part, Paul is going to come up here and strangle me in just a minute. The only thing they can differentiate on is pricing. So what do? You just price lower than the guy next to you, because you can't do very much other than price lower than him. So this is what's driving this net interest margin compression. 3.20, this is when money was flying out the door, and we were also, this is when we had no rules. This is when we had too many rules. Okay? So that gives you a sense of what it's like in the marketplace right now for lenders. Now there's a rate forecast that I want to try to pull up here and see if I can do that for you quickly. That again, Joe was kind enough to put together. I think I've got it right here. That's the same one. Okay. With that, I will move on because I don't think I'm going to be able to find the one that I wanted to show you. What I want to then address beyond what Joe presented was a little bit about the perm market, life insurance companies and conduits looking at permanent mortgages. What I'm seeing in that marketplace is it's not dissimilar from the banks. The profile of loans that lenders will look at is still relatively narrow. It is expanding slowly. I have a $4 million loan right now that is at 4.15 for 10 years, non-recourse, and it's right at 65% loan to value. So non-recourse, even at 65%, I don't know, 2 years ago I wasn't looking at that, and I certainly wasn't looking at 4.15% fixed for 10 years. The lender likes the property, they like the tenancy, so we have that deal almost done. But the idea is that you've got a similar profile to the banks. If your deal fits in the bucket, money's in the low fours for you for 10 years. If your deal isn't inside the bucket, it's hard to find money, and it's definitely going to have a 5 or a 6 hanging in front of it. So I would tell you that if you can make the profile of your loan, whether you add a guarantor or you lower the loan to value by paying it down a bit, whatever you can do to fit in the bucket, you will find some good money out there. But if you can't get it in the bucket, it becomes much more difficult.